Good morning, everyone. I'd like to welcome you guys today to the second installment of Coffee with Carl. I have the pleasure of Whitney Sweeney from Schroder Investments in joining us. Schroder Investments is a global investment advisory firm overseeing over $660 billion currently in institutional and private investor assets. Good morning, Whitney. How are you doing today?
Oh, I'm good, Carl. Thanks for having me this morning.
Wonderful. Why don't we go ahead and get started? What I've done is prepared a number of different questions for you just to highlight what's going on in the market and get your perspective about where you see it currently and where you see it going. One of the big questions, I guess, out the gate is there seems to be a big disconnect between markets and economic data. Jobless claim today just posted another 2 million more jobs lost. Retail sales posted the worst month in history along with industrial production. And yet markets continue to go higher. How can you reconcile this?
No, that's a great question. I think a lot of people are asking that, and the rally that we've seen in markets can be very confusing. As you pointed out, we're seeing some of the worst data prints that we've ever seen, but markets are continuing to drive upwards and have clearly recovered from the troughs we saw in March. Now, why is that? I think there's a degree of optimism. Economies are coming out of their lockdown. We've seen whatever it takes stimulus, material fiscal commitments, not just here in the U.S., but around the world, and heavy liquidity provisions that are coming out of U.S. and Europe. These factors have combined to drive markets back up again. People are also starting to get their heads around the virus. So we have a much better understanding of what it takes to contain an outbreak. So certainly this is not behind us by any stretch, but we know that if we take certain actions, we actually can be successful about containing that outbreak. So the virus has moved from what I'll call more of an acute risk to market to more of a chronic risk to markets. We've also seen positive developments on vaccines, on medical treatment. So people and markets are starting to look through to a recovery.
You mentioned vaccines. Can you highlight a little bit where we are and frankly, where you see the market going if we were to find a vaccine? Do you expect markets to push even higher? Where do you think that threshold might be?
Oh, okay. I think that's a great question. It's probably the biggest question out there in terms of what is the timeline for getting a vaccine? And as you have seen, markets are rallying on any piece of positive news with respect to that. I think when we think about what do we mean for that, I think that a lot of people are hopeful that we'll have something sooner than later. From what I have read, I have to throw out the caveat, I am not an expert. I'm not an epidemiologist. I do a lot of reading. The earliest that I've seen, and I still think is really, in my own opinion, is relatively unlikely, that you'd see potentially something in the fall. It'd be in very limited quantities. You're looking more likely to something 2021 would be more likely. At this time, from what I've read, there's about 10 vaccines that are in preliminary clinical trials. There's a little over 100 that are actually in preclinical evaluation. So what does that mean from a market perspective? If we were to get something that came out that actually, one, came out sooner, and two, whether it be a vaccine or treatment, so the vaccine is really what we really need, is that would be very positive from a market standpoint. And if you think back, this is a self-induced recession, right? The U.S. consumer was in good shape coming into this. So to kind of state the obvious, the faster we have that vaccine, the faster restrictions can be eased, businesses are allowed to reopen, the faster we get that recovery and economic activity. Markets are still pricing in a lot of optimism right now. And to us, that's something that would be a little concerning as we go forward.
I guess from a market perspective, if it were delayed 6 months, a year, how do you think that would affect the market? Would that say, hey, if we're not going to actually have a vaccine out until middle of end of next year? Would you say that might lead to a 10, 20% drop? Just want to give the listeners an idea of what the ramifications of that might be if things don't work out perfectly, which is where we seem to be projecting.
Well, I think that's without throwing hard numbers on it, because I don't necessarily want to throw this specific number on what kind of a drop we could see. What I think we're looking at is potentially really choppy going forward. And we've already seen that in terms of market moving on small pieces of information. And as you pointed out in the beginning, that really big disconnect. So sometimes you'll see news, and when you look at what the market's doing, it doesn't always seem to make sense. When I think about what kind of recovery do I think that we're having, we threw around last time the V, the U, the W, the swoosh. I think what we want to look at is what we're seeing from a data perspective. We here at Schroders, our economists have downgraded the forecast for global growth again. This just reflects the weakness of the first quarter. So if you think about how weak that first quarter has been and how weak we will expect to see this second quarter be, that we actually are seeing signs that we're past that worst. That's good from an economic standpoint. That's good from a market. We should expect to see a bounce back in activity next quarter. We're going from a complete shutdown to reopening. So however slow that's going to be, you'd expect to see some improvement over the summer months. We're also seeing that some of those high-frequency indicators are starting to show nascent signs of green shoots. If you look at China, that road to recovery, 93% of consumer services are back in business. I'm not saying we're certainly not back to where we were, but we're actually seeing positive signs. If you look in Europe, if you look at toll road traffic volume, and I think these are countries where they're not out of the woods yet. But we're seeing that toll road traffic volumes in France, Spain, and Italy, they've all edged higher. Data, Google Mobility Tracker is suggesting that we're seeing improving activity levels at a number of different places. So when we think about looking ahead to the economy and what that means from market perspective, it's really as much at this point in time about a judgment on how quickly those lockdowns will be lifted and the path of that virus. What we think is that the central view is that the virus will be contained. That said, those epidemiologists are stressing the risks of a second wave infection. If you get that, you're going to get rolling lockdowns. And I think when you look forward, a concern around whether we get the vaccine this year or next year is recognizing that whether or not we have official lockdowns, that what you've seen when you look at the mobility data is that people have actually made their own decisions. So we actually saw a slowdown in economic activity before we had official lockdowns here in the U.S. And kind of on the flip side of that, we've seen the opposite. So as states are beginning to reopen, and some states, still are officially closed when we look at that, but you're already seeing that mobility data telling us that people are starting to move around and getting back. So I think things are going to change, but I would say looking forward, we should expect it to be choppy. But the good thing is that the more time that we have behind us, the further we get to information from a medical standpoint that is positive, whether or not we get that vaccine in the short term or a little bit more medium term.
So I guess one of the questions I would have too is along the same lines. Right now we have a lot of protests going on. So you have a lot of people in very close proximity of one another, which I would imagine could potentially ignite the virus even further over the coming weeks. Are you guys a little bit concerned about that in the short term? Or is that something that is just really along with everything else, which in time all of this will pass?
Well, in time everything passes. But I will say, yes, it is concerning. If you look at Macy's, so they have a 2 million square foot flagship store in New York. It's the largest in the country, and it got looted Monday night. Retail becomes the target because it gets attention. And if you think about it, these protests are coming at not only the very worst time in the midst of the pandemic, but right on the edge of everything opening and really what we'll say, just crippling circumstances as we're starting to be able to open. When I think about the protests, I think there are two things that we think about the impact. I'm going to take the health standpoint first, and you're exactly right. Are we going to see a spike in cases in 2 weeks? And does that then lead to further shutdowns? I don't think that we'll see an official shutdown, even if we see a spike in infections. And, kind of as I think about it, I go back to that whole, the mobility tracker data and seeing what people are choosing to do. So I think that you're going to see an increase in spikes. That potentially would have an impact on how quickly some businesses that were set to reopen will reopen. I mean, I'm just going to look anecdotally. I happen to be near an area that actually had a decent amount of looting going on, and reading some of those small businesses, they are hesitant to reopen as they had planned to this week. So there will be a little bit of delay. I think it's also a regional phenomena based on what you see close to home. So do you know people that were impacted? For some people, it's just on the news. It doesn't really affect their daily behavior. So that's going to impact their behavior. So I do think that there are some implications. I don't think, again, that you're going to see widespread shutdowns, but I do think people are watching very anxiously to see what does this mean in terms of the cases spike up. And it's not just the protests. I mean, you saw people over the weekend, Memorial Day weekend, people are going out. They're trying to take precautions, but they want to get out and do more. The bigger piece of that is not bigger. I don't want to minimize the health aspect. It's a policy standpoint, right? So you've got mass civil unrest around our country. You're actually seeing, countries outside of the U.S. now protesting to support what's happening here in the U.S. So that's a really broad response. And when you think about what do protests mean for investing in markets, well, if you look back historically, protests affect policy. They haven't really impacted stocks. So if you think about it from a policy standpoint, you could expect to see resolutions that come out that condemn police brutality, commissions to examine race conditions, police reform, those policy considerations. If you think about the combination of protests, really high unemployment, and there's a lot of people that, the pandemic is playing into this in terms of frustrations around employment, that could actually impact that ongoing economic stimulus discussions that we're having. So if you think about what does that mean, looking at aid to state and local governments, unemployment compensation. So that's actually where you could see those protests that actually will start to change the dialogue with respect to what we see from an economic stimulus standpoint.
Makes sense. I guess, and again, it seems the market continues to blow through a lot of the data and the protests, et cetera, just for the thought of the market reopening. What are your guys' concerns right now that could shift the market back the other way outside of just the virus?
Okay, well, the virus is the biggest one. So I'm going to say that stands out. And uncertainty, and I know we kind of touched a little bit on this. It's the one thing that markets really don't like. And there's a lot that we don't know about. I mean, a lot of times if we started at the beginning of the year, I would have been talking about geopolitical risks. One thing we definitely want to talk about is what's happening from a U.S.-China perspective. But markets, once they know the bad news, they can price it in and they begin to look through. So when we look at markets today, it looks like the worst of the economic downturn is behind us. So even a small reopening is better than this complete economic shutdown that we've had. What we don't know is how quick that pace of recovery will be, how long it takes to get back to normal. So when we look at markets and how quickly they've moved, and that lack of a risk premium in a lot of asset classes is concerning to us. So we have a very large hole to get out of to get back to normal growth. Some of the markets don't seem to be pricing that back in. So a couple of the things that we'd be thinking about kind of going forward that could cause that pullback, increasing pace of infection and death, policy actions falling short of expectations. The market has really high expectations, and so far we've delivered. Will the economic and earnings fallout be greater than what we've expected? Are we opening too soon? I'm going to throw out a really big one on top of that. Which is, of course, increasing U.S.-China tensions. We've started to see that. U.S. is blaming China for not being fully transparent. They've taken a hardline stance on Hong Kong. We would think that this is probably going to ramp up, or the rhetoric will ramp up going into the election. And this is actually important because this is a topic that gets bipartisan support. So we'd expect that we'd have continued dialogue on this one.
When it comes to China, where and the reemergence of the tension, what do you think, Trump would do to ratchet that up? Are you concerned with him ratcheting that up, or do you, as far as response from China, do you foresee them throwing any response to our most recent bills with regards to Hong Kong?
I think there's just going to be, I think what you're going to see is strong rhetoric on both sides. I don't think that in the near term that you're going to see anything that is very hard and concrete action, because it's not in anyone's best interest to push it to a point such that it might not play out as one would like. I'm trying to be really careful as I'm thinking about how I say this. Clearly, I think that we are potentially moving into a new trade war era. I mean, if you think about where we were at the beginning of this year, before the pandemic started, we were kind of completing phase one, moving into the next phase of conversation. This is really important because if you look at, and I always try to kind of stay away from politics other than what history tells me or what the economic implications of anything is, but if you have an incumbent president that has a good economy, that's very positive. So if you look at that, we're in a very different place right now. So I think that the rhetoric around China is actually going to be to some degree dependent, or influence is probably a better word to use, on what we're seeing with respect to the economy and the virus. So if the economy starts doing really well, then there might be less of a rhetoric around taking a really tough stance on China, because right now it's a way that we can actually defer conversation to something else, and it's very positive on both sides. So again, the key that it's a bipartisan view to be, that China, it's unfavorable, and it's good to be tough on China right now. So I think that as we get closer and closer to the election, and if the economy is still doing poorly, you're going to start to see that rhetoric pick up. That's actually not going to go away, even if, despite who wins the election, whether it be Trump, whether it be Biden, those tensions aren't going to be going away. They're going to be handled very differently depending on who is in the White House, but they'll still be with us. I think if it's a Biden, you're going to have kind of more of a way to approach it from a global perspective. But I do think that that's something that's going to be with us for some time. I think thinking about it kind of a step back is thinking about it from a supply chain perspective. That's one of the questions that I get a lot. And we'd already started to see that push to move supply chains out of China. That's actually coming when these conversations first started. So in a way, we're starting to pick up some of those conversations that we had before that aren't easily resolvable. Because if you really kind of think about, what's happening from a China perspective, there is a lot that we're thinking about that, it's not just these specific instances in terms of what's happening from a delisting standpoint, what's happening from supply chain standpoint. It's really the underwriting driver is that we have this rising strategic competition between U.S. and China. So that doesn't go away. And that's, I think, the key piece. So we've already started to see those supply chains move out. It's going to be slow, quite frankly. It's not an easy task. There are huge sunk costs. It's a huge cost to actually diversify that supply chain. It's going to take time to happen. Number of characteristics that a country would need to have, like access to land and power, availability of labor, decent labor costs, strong labor system. It's not easy to find a country that can tick all of those boxes. So I think you'll see a movement towards diversification, but it's certainly not something that's going to happen overnight. One thing that you might start to see is that some of those more critical industries, and you actually saw this happen before. It actually happened after 9/11, where you might start to see legislation to bring some of those industries back to the U.S. And we've actually already started to see some talk around that.
Yeah, and it seems like the U.S. is also trying to push our global partners like the U.K. to work together to move away from China as well.
Exactly. I
I
think
guess
you'll see more of that.
one of the next, and then taking a shift away from some of the concerns of the market, where do you see the opportunity in the stock market?
I think there's actually a lot of opportunity. When you think about when markets are really volatile like this, the ability to be a good stock picker matters. So there's some areas that we think are really pretty interesting. So when we talked last, I think I talked about small cap. It's an area, if you look, that small cap rally since that March low is one of the most impressive that we've seen in history. Continues to be an area that we see as opportunity. Small cap space was one of the markets that really felt the most pain. So if you go back to the midst of that small cap valuation spread spiked. It was just about 5 standard deviations above the average. That's just short of what we saw from an all-time record that was set in the global financial crisis. So it's come back a bit since then, still attractive. So that's an area we would think there's some opportunity. Another area that we think is really attractive, and again, I touched on this last time, is international over the U.S. There's a couple of reasons for this. First, underperformance of international stocks in the past decade means they're currently cheap to the U.S. market. They're also cheap to their own history. So if you think some of those headwinds that international markets experienced, so, that continued strength of the U.S. dollar, which is something else we could touch on, particularly as we watch what's been happening to the dollar recently, those are starting to fade, and we're seeing new tailwinds that are created by that massive fiscal and monetary stimulus. It's being used by places like China, Japan, the U.K. They're actually starting to see Europe, led by France and Germany. They've never been willing to stimulate growth like this before. So if you think about parts of the market that are going to be favored by a global economic recovery, international markets, they're higher beta, higher operating leverage markets. So we think there's just a lot that can go right in international markets, and expectations for these markets are really, really low. So just to kind of throw a couple things out there is, if you look at U.S. large cap equities, they're rich to developed and emerging market peers on almost every metric. So if you look at forward PE, price to book, price to sale, CAPE ratio, that's from our perspective is that the return potential is lower in the U.S. equities market than it is for foreign. So that's an area that we think there's a lot of opportunity.
Would you lean more towards the emerging market sector or the developed markets, international?
Well, I would say I think there's opportunity in both. I think valuations are more compelling in emerging markets. So we do see a lot of opportunity there. When I think about what our international managers who have the ability to go into developed markets and emerging markets, where they're seeing opportunities, they're seeing it, I would say, in both. One of the things that they would be looking at is not specifically identifying which countries do they want to go in specifically, but where am I going to find the best good companies, resilient companies with strong balance sheets that are trading at good valuations. That's what they're looking at. So what they're seeing is really more opportunities. I'm going to kind of move away whether it's be developed or emerging market, although I will say valuations in EM are more compelling, that it's more cyclical parts of the market. So kind of moving away, if we think about more cyclical as relative to growth and quality, because the expectations for most companies in that space are very low. It doesn't take much improvement in economic fundamentals to really generate significant operating leverage, share price appreciation going forward. So that's actually parts of the market that we really think that there are more opportunities. That security selection, active management is really important. I don't want to say that all cyclical businesses are going to recover from their lows, but that's a part of the market that we think is pretty attractive.
Are you foreseeing any sort of pullback, as a lot of these both domestic and international companies continue, and the markets as a whole continue to go up?
I do. I mean, I do think that we're going to have a choppy market. I mean, when I think about the fact that markets really, I think they've priced in too much optimism. So I would say that if we look going ahead, that we should be thinking that there is the markets are going to continue to be choppy, and we would expect to see some kind of a pullback. As I said, the market is moving sometimes on news that, I think it was one of the virus vaccine data that came out, which has continued to get positive news, but the very first piece of news that came out was that 8 out of 8 people had actually responded positively. 8 out of 8 people. Like, there's nothing significant about 8 out of 8 people, just from a statistically significant standpoint. So markets are moving somewhat irrationally. We do think that there is a lot of optimism that's been priced in. So do I think that there's room for movements downward? I do. And actually, if you look back to history, which is something that's kind of interesting, and if we go and we look at kind of how markets have performed and how quickly you reach that recovery after something, if we look to history, and I'm actually trying to think back to some of the data, so the longer that you're in a recession, the longer it takes for you to peak. So, kind of if we look at it from that standpoint, that would tell us that we probably do have some more choppy waters ahead of us.
Now, how would you combat that? By having cash in the portfolio, or maybe looking to absolute return strategies as a hedge? What are you guys doing to prepare if there's any pullback in the market?
Well, I'll say that a lot of our portfolio managers, again, it comes down to identifying specific companies that we think have good balance sheets and the ability to weather something. The fact that we are seeing parts of the market that have greater opportunity. So again, focusing on those parts of the market, international value stands out as an area that potentially has some opportunity. And I will say, when I even think about some of our strategies, they're not value strategies. They actually would be more core. So, have the ability to kind of go both. Where they're seeing more opportunities is specifically into some of those more cyclical names. So, you really do pay a price for sitting in cash. And again, that's a very unique, very specific to individual investors, what their tolerance levels are. But from our perspective, while some, and I'm going to say some because not all portfolio managers have allowed their cash to creep up a small amount to take advantage of opportunities, there's a lot of opportunities in these markets. So the key is really trying to identify those companies that we think have the opportunity over the medium term to have their earnings recover. So I don't know if I used this quote the last time we spoke, but, I've heard it, kind of in different ways from several of our portfolio managers, that this is an opportunity where you can actually improve your portfolio. So whether it be names that you had actually identified that you liked, but you didn't think that price point was attractive enough to enter, because it's all about that entry point. So are you now adding to, or are you buying names that you liked previously but were too expensive? Are you trying to identify those companies that actually, looking forward, that there's an opportunity for them to deliver long run because they have strong balance sheets, they have the ability to make it through? So very clearly right now there are real opportunities that portfolio managers are finding. And again, if you look back, kind of just to take a step back and look at active managers versus passive managers, when you have markets that are really volatile, if you look at the returns of active versus passive, this is really where the ability to pick stocks, to pick companies, to identify what the winners are going to be is when those managers really can add value. So again, while it's a personal decision, this is not a period of time that our portfolio managers are sitting on cash. I'm not going to say that, cautious is, it's good to be cautious, but it's an opportunity to try to identify those companies that we think are going to perform well going forward, and they absolutely are out there.
You mentioned the value space. Let's talk briefly, and before we finish up here, what about some of the beaten down sectors like banks, real estate, airlines? What do you think about some of those areas? Do you see them as areas of opportunity, or would you still stay clear of them given all the uncertainty in the economy?
Well, I think, okay, now that's a question that, dependent on which portfolio manager, you might get a little bit of a different answer. I will say the key piece is quality. So banks stand out. there are some banks that are very strong from a quality standpoint that actually still fit that value metric. So that's an area that
JP
can
Morgan
be of
or
interest.
what specifically?
I generally am not going to talk to names, but I'd be thinking kind of some more names that are outside of the U.S. when I'm thinking specific
Okay.
to that. I will say that our portfolio managers tend to be a little wary of banks. Where they might find some opportunities would be more in materials or industrials, where they can actually they don't have to take on those balance sheets of banks. They get good quality, they get good balance sheets, so they can take advantage of those alpha opportunities. That said, I don't want to say that there's never going to be a bank, but if I were to kind of choose one versus the other, that's an area where they see that they get better opportunities without having to deal with some of those balance sheets. That said, there are some banks that are particularly attractive that actually can meet both that quality piece as well as the value piece. And I think if I were to say there's one underlying theme that kind of goes across a lot of the way the portfolio managers think is that bias towards quality. And everyone's talking about quality right now. Everybody wants to say that they have it, that that's what they look at. But at the end of the day, when you look at a lot of the strategies that our teams are running, it has been that bias to quality that has actually helped it to outperform. So whether it be a strategy that's strictly looking at international value, that piece of that is quality. So just having value and buying cheap because the stock is cheap, that's really not going to help you in the long run. So if you look at actually some of our value strategies, what's allowed it to outperform a value benchmark, and actually right now the value and the blend benchmark, is the fact that they have that quality bias. So just because something's cheap isn't the point. You need to make sure that you have companies that are going to be able to survive in the long run. So I think that that's something that's an underlying theme, is that you want to make sure that you're identifying those companies that are actually, I'll call them high quality businesses that we should be choosing from. So if we're thinking about it, in the international space, you're looking at, value sectors, more economically sensitive industries, small and mid-cap names. And again, we do like EM.
No, thank you. That's a great explanation. Our time is up today. I just want to go ahead and say thank you, Whitney, for joining us and providing us all this great information. And I hope everyone enjoyed the call today. Thank you.
Great. Thanks very much.
Take care, everyone.